Are you someone who's always looking for, well, shortcuts to stay informed and maybe also wants to win big financially, but without all the constant effort? Today, we're doing a deep dive into an investment idea that promises exactly that. We're looking at how a so-called lazy portfolio can actually, surprisingly, outperform much more complicated strategies.
That's right. And our mission here is to really explore the thinking behind this. We're looking at insights from giants like John Bogle, Benjamin Graham. Their principles suggest, maybe counterintuitively, that doing less often gets you more. We want to show you why simplicity, low maintenance,
Yeah.
why there's such powerful tools in the market.
Okay, but it does sound a bit weird, doesn't it? Doing less yields more. Why are so many people still, drawn to active investment management, even when the results are often, well, disappointing?
Yeah, it's a great question. And our sources point to a couple of key things: behavior and costs. First, behavior. Investors themselves often have these counterproductive short-term habits, constantly churning their portfolio, trying to chase returns.
Okay, so jumping in and out.
Exactly. And actively managed funds, they often do the same thing. High portfolio turnover. Think like rapid-fire trading. It's not just busy work. It creates real costs for investors,
Yeah.
transaction costs, and importantly, tax costs.
Right, those taxes can really bite. But what about picking the right active fund? Surely some managers are geniuses. Don't things like Morningstar's star ratings help find them? What about past performance?
Ah, that's the tempting part, isn't it? But this is where it gets really interesting. Our sources are pretty clear. Superior past performance just isn't very predictive of future success. Those star ratings, they have, and I quote, little predictive value.
Little predictive value.
Yeah, and trying to trade based on them. It can actually lead you to below market returns, but with above market risk. It's almost
Yep.
ironic. The harder you try to find that winning edge, the more likely you are to trip up.
So if complexity and frantic activity are actually working against us,
Mm.
how do we put this simplicity into action? What does it actually look like for our listeners?
Well, the core idea, and this comes straight from people like John Bogle, is just simplicity. He famously said, "The secret of investing is, finally, that there is no secret. Just keep it simple."
Secret.
And Benjamin Graham, another legend, he agreed. He basically said the ideal choice for most people.
Yeah.
A total stock market index fund. It's a low-cost way to own essentially every stock worth owning. It's just hard for our brains. We think more effort equals more reward, but investing often flips that script.
Okay, so for you, the listener, the busy learner, this means embracing broad market indexing, just buying the whole market, basically.
That's the essence of it. And look, even famous active investors admit this. Peter Lynch said most investors would be better off in an index fund. Charles Schwab, he pointed out only about 1 in 4 equity funds actually beats the market. That's why he was a firm believer in the power of indexing.
1 in 4. Those aren't great odds.
Not at all. And think about this. It's been stated that the average fund can never outperform the market in total.
Why not? Mathematically.
Exactly. Because before you factor in cost, all the active funds together essentially are the market average.
Yeah.
Then you subtract their costs, those management fees, trading, taxes, and the average active fund has to underperform the market index, which has super low costs. That's the key advantage.
Ah, the costs again.
Yes, that low-cost structure is huge. Like a passively managed, balanced index fund might have a 0.6% to 0.9% annual advantage purely because its sense ratio is so much lower. Maybe 0.2% versus, say, 1.0% for an active fund. Seems small, right? But over decades,
It compounds. The tyranny of compounding costs, as Bogle called it.
precisely, those small differences become, quote, staggering. Think about it. That $10,000 invested in an index fund might capture, say, 97% of the market's growth over time. The average active fund, after costs, maybe you only capture 70%. That's a massive difference in your final wealth.
Wow, 97% versus 70%. That really paints a picture. And it's not just the expense ratios, is it?
No, not at all. Index funds, because they trade so little low turnover, they are way more tax efficient. That boosts your after-tax returns even more, which is what actually ends up in your pocket.
Better returns, more tax efficient.
Yeah.
What about risk? Isn't buying everything riskier?
Actually, no. The research suggests broad market indexes carry substantially lower risks than the average actively managed fund. You're getting diversification across the entire market, rather than concentrating bets like many active funds do. So often, it's better returns and less volatility.
So for you listening, the busy person wanting to learn and apply knowledge effectively, maybe the path to really winning in investments isn't about hyperactivity, but about simplifying, about doing less.
Absolutely. Remember those key phrases? Time is your friend, impulse is your enemy. The biggest risk over the long term isn't really the market going up and down. It's not putting your money to work efficiently or letting costs and emotions eat away at your returns.
So here's a final thought to chew on. What if the most powerful way to achieve real financial success isn't about constantly trying to outsmart everyone else? What if it's about embracing the profound power of thoughtful inaction?